Hello traders, welcome to this strategy video. Today I'm going to take you through a Fibonacci strategy. So why should you use this strategy? Well, this strategy is basically for traders that are looking to not spend too much time on the charts or have little time to actually invest into trade in the lower time frames such as the intraday markets. It's actually for people that are looking to try and catch those trending moves without having to sort of commit too much time in the markets. Now, how does a Fibonacci retracement tool work? Well, it's applied by taking two extreme points on a forex chart. It can be the high and the low of a price movement, and then horizontal lines are plotted on the charts. They're known as the Fibonacci levels, and typically you have the 0, 23.6, 38.2, 61.8, and the 100 level. We also need to apply a extension tool onto our Fibonacci, which I'll show you how to do a little bit later in this video, and that's going to be our targets essentially. Now, how do we use it? You can see here I've just got a chart here and the market is in a downward trend. Now, the way I apply my tools is my Fibonacci tool is a little bit different to how most traders would. They would apply it from the swing low to the swing high, and they would be looking for the 38.2 first and whatnot. But I actually plot mine a little bit differently. The reason why I do that is because I like to see the positive sort of numbers. Otherwise, you have to put minus 127.2 into your Fibonacci tool. So the 61.8 and the 38.2 distance away from 0 and from 100 is exactly the same. There's no difference between those two levels apart from the number. So that's absolutely fine, and these are the two levels that we're going to highlight today as we go through the strategy, as well as the 127 extension. So first of all, we've got to identify that trend, and this is how we use it. We go from the swing high down to the swing low, and we plot our Fibonacci retracement tool and the key levels. We want to highlight in particular, like I said, the 61.8 and the 38.2 as we go through this strategy. Now, simple strategy rules, simply, we want to identify a trend in market, we want to apply the Fib tool to the desired direction, and then we want to place a buy limit or sell limit order at the 61.8 and 38.2 Fib levels with 0.5 risk per trade. And then your stop loss goes at the 0% level and target the 127.2 Fib extension. So essentially what we're trying to do here is catch the trend in market using limit orders, and then we're trying to target 1, the bottom, target 2, 127 extension to give us a little bit of an edge in the market. So I'm going to pause the video here. I'm going to jump onto a chart. I'm going to show you how to apply these rules. So here we are. You can see I'm on a H4 chart of pound US dollar. We also want to use higher time frames when trying to trade this strategy. Like I said, it's meant for people that don't have a lot of time to put into the market. So it's no point trying and jump on a 5-minute trend or a 15-minute trend. It's just not the way to go about this. You want to apply this on a daily chart or a 4-hour chart. Now, the way you want to do this is we want to find a trending environment. So you can see here, if I just scroll back a little bit, we have that trending environment sort of from this high back here in August all the way down to this low. You can use moving averages as well to try and help you identify a trending scenario. Obviously as well, apply other different types of biases into the market. So seasonal analysis, fundamental analysis, strength and weakness analysis, everything that has to come together for you to identify a particular type of trend. Now, the way I like to do this is we've got to identify significant high or low. So because we are looking for downward trend moves in this example here, I know we're looking in hindsight, but this is how we would apply this particular tool. So let's say price, you can see we have this swing high here down towards this swing low. What we're going to do is we're going to use the Fibonacci extension tool. I'm going to draw it from my swing low and I'm going to apply it to this swing high here. Now, I'm just going to make sure that connects to that high. And what I'm going to do is just drag this out just for this particular example, because I want to show you how you would then place your entries, stops, and targets. Okay, so I'm going to use a rectangle tool. We're going to use a rectangle tool here. I'm just actually going to change it to green, and we're going to do this so that we can actually identify that that is the target zone. And I'm actually going to just make sure that this is filled in, just so it gives us a little bit of an area. So the first entry on this retracement move here is going to be the 61.8. Okay, the 61.8 area is going to be something we want to target first, and we're going to target down to the 127 extension. So what we're trying to identify is that on this move down here, we want to be looking for the 61.8 as a reaction point with a sell limit. And you can see that the distance from the 127.2 extension is 160 pips. If I then drag this up to the 0 line, you can see it's around about 150 pips. So where our stop loss now goes is from the 61.8, okay, up to that 0 line. So it gives you just a slightly better edge, okay? So you'll have just over a 1-to-1, and I'm just going to put that as orange. So that is our stop loss level for the first trade. The second trade comes at the 38.2, because what we're going to try and do as well is try and get on the potential that the 38.2 might be the level. Now this one is where you're going to get the better results in terms of risk reward ratio. Okay, the first one is for the stronger markets. Typically what we can see is if price comes back to the 61.8 and continues to move to the downside, the market is in a very, very strong downward trend at that point. Okay, so we've identified the high, the low, we've placed our first trade. The second trade is here. I'm then going to grab my stop loss, and the stop loss this time just goes at the 0 level again. Now the theory behind this is that if we are looking to sort of jump on a trending market in particular, sorry guys, that one is just not connecting because of the little thing there, so let me just try and drag that down a little bit. So what we're trying to do essentially is jump on a trending environment. Now, in theory, price should not go back above the 0 line in a trend, okay? If this market was in a range, then yes, there should be potential for price to come back to the swing highs. But in a typical trended market, you see price retrace and continue to make lower highs and lower lows, okay? So that's what this type of strategy is trying to get out of the market, okay? It's to trying to take those trending environments on a particular forex pair, okay? So you can see here, obviously this one is around about a 1.1 R return, and this one here is a lot better. We can obviously see that from the 38.2 down to the 127 extension, it's 216 pips, and to the swing high here, it's 90 pips. So that's just over a 2R trade there. So you can see how using the 127 extension can help increase that risk reward ratio. Now what you may want to do is not take the first one and just look for 38.2 pullbacks. That's absolutely fine, but you will miss out on some moves. Now obviously, because you've taken 2 positions in the market, you don't really want 1% risk on both trades. Instead, you want around about 0.5% over the 2. Okay, so you want 0.5 and 0.5, so that you're risking 1% in total. You don't really want to risk more than that. Generally, you're speaking, you'll try and get a little bit about 1% or above on the 127 move, and in here you'll gain about 0.5% or just over. So you're looking for about a 1.5% move in total. Now obviously that depends exactly on how you want to use this strategy. You could not use the 61.8, you could just use the 38.2 and use a 1% risk. Then obviously that is up to you on how you go about managing that potential position to the downside. Essentially though, you could look at every single pullback. If you want to get really critical and have a little look at every pullback in the market, here you can see the market makes a move to the downside, it forms a low. You could then look to apply your Fibonacci there. You can see that we hit the 61.8, we hit the 38.2, and we hit the 127 extension. If you want to look at it again here, this time the market will probably not hit the 38.2. So this is an example where we come up into the 61.8 and reject down to the 127 extension. Again, the market makes a move down and pulls back a little bit. This one also comes up into the 60 31.8, if I can just move that back into the high, and not the 38.2. So this is examples of it not hitting that 38.2 fib. But essentially what you're going to be doing is looking for a downward move in line with trend. Obviously you can apply different tools to help you do this, maybe a 200 moving average. If price is below it, you want to be looking for your short trades. If price is above, you want to be looking for your long trades. But essentially you're going to just be plotting an area on the chart where you say to yourself, okay, we have an impulsive move in here. I'm going to set a limit order at 61.8 and 38.2, and I'm going to target the 127 extension. Obviously, if it goes further, great. You can either keep one trade running and the other one running as well, as long as you like, essentially. But this is how you can use the Fibonacci retracement tool as a potential strategy going into 2024. So thanks for watching the video. I really hope you enjoyed it. Please subscribe to the YouTube channel, and I'll see you soon.